good bank versus bad bank. The world has changed on account of COVID-19. The monetary and fiscal policies by the government and the technocrats, improving the money supply, increasing the liquidity, ensuring business continuity is on, and free incentives are given to make sure there is no disaster in the overall sustainable value creation. So business continuity was aimed at mainly. At the same time, we also see the complexity in terms of balance sheet. There's a huge amount of debt restructuring taking place. Debt servicing capacity has changed for individuals and institutions, countries and continents. Now, how do we manage it? By splitting the good side and the bad side and work on restructuring and remedial management to improve the overall values. Government around the world has provided liquidity and also monetary and fiscal prudence in tandem. There's an alignment around the world. Trillions of dollars have been pumped to improve the liquidity, inflate the countries. There are key developments in many parts of the world. India is a classic story now. Indian bad banks, there are resolutions passed. So asset reconstruction company is a solution. How is the proposed structure? What are the issues which requires our attention? How the India Bankruptcy Code procedure works is vital. The creation of a new ARC, National Asset Reconstruction Company, and a new asset management company was announced in budget 2021-2022. The banking system, despite resolution of major stressed assets in the last 2 years, whether it is SR or Bush and Steel or DHFL, is still weighed down by a sizable NPA portfolio. The new ARC, Asset Reconstruction Company, will address legacy NPA worth of 2 lakh crores. The 100% provided NPA is the initial major criteria for a proposed transfer to ARC, which will be a win-win proposition. Assets can be assigned to a close to realizable value with upside cushion and, importantly, no incremental hit on the balance sheet of lenders. So it's important that you don't face the problem as on date. How can this be worked out? This will also provide resolution of flexibility in the new ARC. It will enable banks to focus on credit growth. So ARC have to play a big role, significant role of the stress asset for almost 2 decades and asset management that is substantial. But a significant drop in transaction has been observed over the last 3 to 4 years due to withdrawal of provisioning protection to lenders on debt assignment. ARC's capital constraints for larger assets, price expectation mismatches in debt aggregation, etc. are the main reason. Capital constraints in large assets, price expectation mismatches, and delays in debt aggregation are the main reasons for drop in transactions. By addressing these issues and precedents, the proposed bad bank construct tick most boxes. So, capital constraints can be minimized, improve the risk profile, improve the liquidity, improve the profitability. So, Reserve Bank of India stress test showed that a bad loan ratio will rise to 13.5% by September. So, the Indian Banks Association proposed to the RBI creation of bad bank with initial focus on loans fully provided for and not resolved either under IBC or other extant framework. So what's the proposed structure? The national ARC will be formed to acquire 50 to 60 assets with a debt exposure of more than 500 crores. The equity contribution for the ARC for cash payout, you have to pay money, isn't it, would be infused by 11 identified lenders, 9 banks and 2 financial institutions. The national ARC would indicate the base offer price for the asset at the time of assignment, and a Swiss challenge method will be followed for a compliance perspective. So you have base offer price for asset at the time of assignment. These assets will be transferred to the national ARC at 15% upfront cash for acquiring these assets at a base price. So you have security receipts would be issued for the balance of 85% to transferring the lenders, which are expected to be partly guaranteed by the government. These securities can be traded to allow lenders to monetize the security receipts in the secondary market. Very important. You will transfer these assets to asset reconstruction, presuming no other outbidders, at 15% upfront cash for acquiring these assets at the base price, whatever be the price. Security receipts would be issued for the balance of 85% to transferring the lenders. Again, that will be guaranteed by the government. The securities can be traded. So you issue a debt paper. Asset reconstruction company, through a step-down AMC mechanism, will manage the assets for sale or resolution. The controlling stake of AMC shall be with the private players with the aim of speeding up decision making and ensuring best feasible recovery for the assets. Now, what are the issues which requires our attention? The resolution process must have a sunset clause that require developing time-bound strategies to resolve each category of assets. This will protect from turning mere parking space of sticky advances and balance sheet management vehicle. As a major NPR are fully provided for, pricing can be based on a conservative approach, but as the process matures, new acquisitions can be based on market-driven prices. Reference for different assets, asset pools, mechanism needs to be in place. You need a mechanism to measure and manage. So it's a parking space for sticky advances, balance sheet management vehicle. Simple. Till the resolution is acquired of the assets, unless you sort it out these bad assets, there may be a need for interim critical funding for sustainable quality assets and advisory support for scouting investors, for which a sustainable mechanism is needed. A regulatory framework and a market for distressed assets needs to be created to determine the market value of these assets. Now, when it comes to Indian banks' bankruptcy code, a law for insolvency is submitted to the adjudicating authority, what you call NCLT. In case of corporate debtors, by financial operations, creditors, or the corporate debtor itself. So the maximum time allowed to either accept or reject the ploy is 14 days. If the ploy is accepted, the tribunal has to appoint interim resolution professionals, what you call IRP, to draft a resolution plan within 180 days, 6 months, or rather extendable again by another 90 days, even goes longer, see subsequent cases. There are reasons to believe you need time to mitigate and map these risks. Following which the corporate insolvency resolution process, what you call CIRP, corporate insolvency resolution process, is initiated by the court. For a set period, the board of directors of the company stands suspended and the promoters do not have to say in management of the company. The IRP, if required, can seek the support of the company's management for day-to-day operations. If the CIRP fails in reviving the company's liquidation process is initiated. So bankruptcy codes are very vital, and we have to necessarily, with the buyback option, Qatar did it in 2008 very successfully when the global financial crisis. With the buyback options, banks have put their distressed assets and passed on to the government and took the liquidity. And again, it improved the risk profile, improved the liquidity, improved the profitability. That has to happen in the current context as well, so to improve the overall value streams.